Good morning. So this week we're doing Chapter 2. Chapter 2 is one of the most fundamental chapters in the book. Chapter 1, Chapter 2, and Chapter 3 are the biggies. And we'll talk about the schedule in a minute. We are going out of order. We're doing 4 and then 3. But so we're going to do Chapter 2 today. Okay, now, if you're working on things and as you're reading or watching things and a question occurs to you, I would encourage you to email me that question because questions are always interesting for me to see because I can see what you're thinking. And then on some class days, I'll start out with a couple questions. So I'm going to do that. I got a couple questions this weekend. So we're going to start class by, I'll show you the question I got, and I just copy and paste them exactly like I get them. So this first one. Okay, so this one says, I always considered a debit as something owed. So when using T accounts, how can a debit increase the amount of the account? Well, the whole system of debits and credits is based on the accounting equation. So we have assets equal liabilities plus equity. So when we increase assets, we always need to keep everything in balance. And I will tell you at this point, it's all based on the accounting equation. This is something you kind of have to take on faith that it all works because as we go through this chapter, we're going to end up with our trial balance. And if we've done everything right, our trial balance, the debits will equal the credits. And to do this, it's a double entry system. So some types of accounts get debited and some get credited. So there's not a great answer at this point because we're not there in our knowledge base, but it's based on double entry accounting and always needing debits to equal credits. Okay, so another one I got. Now I kind of added to this one to interpret it like I thought the question should be. She was asking, I always looked at expenses as a subtraction from an account. So why would a prepaid expense increase business assets when it's something they have to pay out, thus reducing their assets? Okay, so let's take this step by step. I always looked at expenses as a subtraction from an account. When you say that, you're thinking about cash. Like I have cash, I spend cash, my cash goes down. So there's the subtraction. But what we're talking about, remember in double entry accounting, there's two sides to every transaction. So when I pay out cash, what's the other side of that cash? It's an expense. Let's say I'm paying for gas. I go to get gas in the company car. So I pay $30. So I hand $30 over. My cash goes down. What goes up? Because when something goes down, something has to go up. Well, the thing that goes up is automobile expense. And when we talk about an account in accounting, we're talking about a running total of some type of account. So in this case, an expense is simply a running total. So when I incur more gas expense, my automobile expense account is going to go up. So when we think about, I think the question when she was thinking about expenses as a subtraction from an account, expenses, when I pay cash, I deduct cash, but there's always a second side to everything, and we're going to see a lot of that today. Okay, couple of questions. The same question came up, phrased different ways. Where can I go for information on tutoring? There's a tutoring link on Blackboard on the left navigation menu. I also put it in a tiny.cc tutoring info. The Academic Success Center here at Kent State has tutoring for this class. It's categorized as other subjects, but they do have tutoring for this class. Also, if you explore that and that doesn't fit your needs, then you need to see me during office hours and we can talk about some other possibilities. So that's a see me type thing. The Academic Success Center is open to everyone, and start there, and they have lots of hours Monday through Friday. So start there, and then we can talk further if you need it. Okay, wanted to refresh you on this. I talked about this the first day of class in case it's out of your memory at this point. In this class, we're going to drop your 1 lowest homework and your 2 lowest quiz scores. Okay, that happens during finals week. And it's your lowest of any quiz, your lowest of any homework. You can earn 1 do-over in addition to those drops. So you can decide any assignment you want you want to redo. To do that, there's some basic rules, and it's pretty easy. First of all, you have to come see me during office hours before, I'm guessing October 23rd. It's right before the second exam starts. Okay, so sometime between now and then, come see me during office hours. Now, when you come see me during office hours, my office is on the 5th floor of the College of Business. My room number is 572, and you come see me for 2 minutes. That's all I want of your time, 2 minutes, and tell me something interesting about you, and then I will snap your picture so I remember who you are. It does help me get to know some names. So that's all it is, a 2-minute commitment, and that makes you eligible for a do-over. So then to use the do-over, you have to return after you have an assignment that you want to do over. So sometime before, I think before December, I have the date on Blackboard, but sometime before the end of November, somewhere in there, you return when you have the assignment you want to do over. It can be any assignment, not an exam, but any assignment. Then I will, when you return, I will go in and I will open that assignment up for you for 1 week. So you get a do-over. So actually in this class you have 1 homework, 2 quizzes, and then 1 of anything else if you do that. And I would encourage you to do this because, number 1, I like to meet people, and it's just really nice to see you outside of class, because when I'm in class I really have to focus on what we're doing in here, and it's hard for me to interact personally, but I would love to talk to you. 2-minute commitment and you get a do-over. Now, some of you were probably impacted. Let's go back to last night. My accounting lab, the server went down for an hour. I've been using my accounting lab for 5 years, and I can count on one hand the number of outages there have been. It is very, very robust. So it went down for an hour. That happens. My tendency is to say, okay, that's one that you dropped. Last night, because it's early in the semester, I went ahead and put an alternate assignment out there. I know several people emailed it to me. If you did that, as long as I got it by 11:59, you're good. You'll see your grade appear under Video Quiz 5 in my accounting lab sometime in the next 2 weeks. So I'll enter those. Now, notice in the future, I always harp on you, don't wait till last minute. This is a lifelong habit to develop. Do not wait till last minute to do anything. If you do, we're talking work, if you wait till last minute, inevitably something will go wrong. So when I tell you assignments are due at 11 p.m., that doesn't mean everything's guaranteed till 11. I would say if there's a 1-hour outage like we had last night, I'm not going to extend them in the future, but that's part of the reason we have the drops. The drops are there for technology reasons, for any reason, or the do-over, but last night there was that opportunity. And I would say, like I said, the chances of my accounting lab going down are very, very slim. It happens very rarely. But if it does go down, it's obvious. It's always when there's something due. So Murphy's Law. But anyways, oh, and you did put up the dates. I do have the dates behind me. Okay, so October, so the get out of jail free opportunity. And if there's, people emailed me that they were going to come see me today, so if you come see me, fine. Remember, these are 2-minute appointments, so even if there's a little line, it'll move quickly. My office hours, just to refresh, are Mondays and Wednesdays from 9:30 to 11, and then from 1 to 2 also on those days. I would not come towards 2. For example, today, Brian and we've had an ongoing issue with Blackboard mobile app at the 2:15 class, so we do leave my office a little bit early to try to troubleshoot that. So, 9:30 to 11 today, feel free to stop up, 2 minutes, and then when you do want your do-over, come see me, and I will open it up right then. You have a week to do that do-over. And those details are on Blackboard. There's fine print, but there's nothing. That's basically it. Okay, so any questions before I leave that? Okay. It's great to see so many people up and at them this early. Oh, I guess I should do this, right? Okay. Okay. Okay, so let's start with the question. This is not a polling question. We don't have any multiple choice under it. So this is just kind of a review to get us back into the material. This was last week. If liabilities are 500 and assets are 1,200, what's equity? So what do you think? Yes, yes. He says equity is 700, and that is absolutely correct. Okay? So what we have there, we have the 1,200 assets equal liabilities plus equity. So 1,200 minus 500 gives us equity of 700. So we can manipulate that accounting equation a couple different ways. So if we're given assets and liabilities, we can solve for equity. If we're given equity and liabilities, we can solve for assets. And that's all, you need to know that accounting equation. Can't emphasize enough. Double entry accounting is based on this. So if we have any transaction, after the transaction, the accounting equation is going to continue to balance. Okay. Okay. If equity is 3,500 and assets are 5,700, how much is total debt? Okay. So yes, 2,200. Good answer. Now, the thing to note on here, we were solving for something different. We had equity and we have assets. Now, notice that I asked for total debt. Debt is another name for liabilities. So don't let that throw you. The terminology can change a little bit. So assets 5,700 equal liabilities plus 3,500 of equity. So we can solve for liabilities, and they're 2,200. And even though I said total debt, that's the same as liabilities. Okay, now we're polling. Okay. An event that has a financial impact on the business and can be measured reliably is A, an expense, B, transaction, C, assets, or D, journal. You can click these in your answers on this one. Okay. Okay, and the answer is you're absolutely right. It is a transaction. Okay? So an event that has a financial impact on the business and can be measured reliably is a transaction. Okay, so that was by far and away the most popular answer. Good. Okay, so now, which of the following business events would not be recorded in a company's accounting records? So we're looking for the transaction that is not, we're looking for the event that is not a transaction. A, the company paid a monthly utility bill. B, the company issued 100 shares of common stock. C, the company purchased 2 acres of land for a future plant expansion. D, the company signed a contract to provide services in the next accounting period. Okay. Okay, so if we walk through these, the first one, the company paid a monthly utility bill. Is that does that have financial impact? Sure, yeah. And can we measure it reliably? Yeah, it's on the bill. So It can't be A. Okay, that's a transaction. B, the company issued 100 shares of common stock. Does that have a financial impact? Yes. Can we measure it reliably? Yeah, because we have what the people paid us for the common stock, right? So it's not B. C, the company purchased 2 acres of land for future plant expansion. Does that have a financial impact on the business? Yes, okay, because we paid cash, okay, we have money going out, and we can measure it reliably because we have the real estate transfer, what we actually paid, okay? So it can't be C. So by default, it has to be D, and let's talk about why D is not a transaction. The company is signing a contract. Did any money change hands here? No, okay, we signed a contract. This will have impact in a future period, but it doesn't have financial impact today, okay? And, or if you said, you could make the argument, I suppose, that once we sign it, it has an impact on our stock, but it can't be measured reliably. We don't know what that impact is. So the answer here is D, a company signing a contract to provide services in the next accounting period where no money has changed hands is not a transaction. It's a significant event, but it's not a transaction. Okay. Okay, so now a lot of this you would have seen in the video lecture. These are in, these lists are in your book. This is not an exhaustive list. This is just an example of some assets. These are common assets. The top asset in any balance sheet anywhere is going to be cash. Cash is your very top asset, and that includes currency, it includes checkbooks, it includes money markets, things that are considered to be cash or near liquid. Okay, next one down, accounts receivable. An accounts receivable is something a customer owes us. So we sell something to a customer, and the customer says, we'll pay you later. So accounts receivable is a customer owes us money. That's going to be cash in our hands later on. The next one down, note receivable, that's typically a loan with the bank. It could be, or not a loan with the bank, a loan to a customer like a bank. So we loan the money to a customer. The customer signs paperwork. A note receivable has a note with it. The customer signs like a promissory note, and they agree to pay us, and they pay typically with a note receivable. There's interest on it. Prepaid expenses. Prepaid expenses are assets. Prepaid expense is something we pay for in advance that hasn't expired yet. Examples of prepaid expenses are office supplies. If we go buy 100 reams of paper, we're not going to use that paper today. We're going to use it over the next 3 months or 6 months. So that's office supplies, which is a prepaid expense. It will eventually be expense when we use it. Another example of a prepaid expense is car insurance. If you pay car insurance a year in advance, because a lot of times companies will offer you a discount for paying car insurance in advance, so that will be prepaid insurance. It's not insurance expense right now. We've paid the cash out, but we don't actually have the expense until we go through each month, and that expires. Inventory is merchandise held for sale to customers. That's part of our normal operating activities. Okay, so the things on the left column are current assets. Those are things typically that are going to turn into cash or be used up within the next 12 months. In the right-hand column, this is just how I work them up. They are longer-term assets, long-term assets, starting with land. Land, we bought it to build on it, to do something with it, but it's there. Buildings, equipment, furniture and fixtures, other assets like goodwill. When Yahoo bought Tumblr, Tumblr's assets were only like 235 million, but Yahoo paid almost $1 billion for them. The difference was for goodwill. Okay, so those are some typical assets. We don't have an all-inclusive list. If we did, companies will have a list of accounts. It's called the chart of accounts. But these are some typical accounts we'll be using. Okay. Liabilities. Okay, so some typical liabilities here. Again, on the left-hand side, I have the current liabilities. So we have accounts payable. Accounts payable are accounts we owe others. So this is stuff we bought in our normal course of business. So if we go to OfficeMax and get those 100 reams of paper, we say to OfficeMax, we'll pay you later. We sign the sheet that says, we'll pay you later. That's an account payable. We, the company that bought the stuff, has to pay for it later, so accounts payable. Then we have salaries payable. This is when we owe our employees. A lot of times companies pay 3 or 4 weeks after the work is done. This is a liability, recognizing that we have a liability to pay the employees. Okay, accrued liabilities, we'll talk about those later. That's in Chapter 3, but just know an accrued payable, accrued salaries, that's a liability. Short-term notes payable, this is a bank loan. We go to the bank, we sign a note saying we'll pay you later. Typically we pay interest on it. The current portion of long-term debt, this is the amount of principal we have to pay in the next 12 months. Okay, so all those on the left are short-terms or current liabilities. On the right, mortgages payable and long-term notes payable, those are liabilities or debts that's long-term, more than a year. It doesn't come due for more than a year. Okay, then we have equity accounts. Now there's lots of different equity accounts. At this point, we're going to kind of restrict them. We have common stock, which is stock that we issue. I'm talking about from the company standpoint. It's stock that we issue. Okay. Then we have retained earnings. Retained earnings is a running total of our revenue minus our expenses minus dividends to date. So retained earnings is a cumulative total of all our income to date less any dividends we've paid. Now, below retained earnings, I put 3 accounts, and those boxes in front were just bullets that turned into boxes somehow. Okay, so revenues increase retained earnings, expenses decrease retained earnings, and dividends decrease retained earnings. So when we look at revenues, expenses, and dividends, they are typed like sub-equity accounts. They're typed, they can be classified as equity accounts, depending on how you're talking about it. Those accounts, revenues, expenses, and dividends, all impact retained earnings. So when we have an event that occurs, like we sell merchandise, our revenues are going to increase retained earnings from that sale. Okay, so another question. This one you can click in on. Which of the following is a liability account? A, retained earnings, B, accrued liabilities, C, accounts receivable, D, prepaid expenses. So what is the answer for this? B. B, yes, you're right. Okay, so the answer here, okay, accrued liabilities is the answer. That is a liability. Yes, in majority rules, okay, it is B, accrued liabilities. Okay, another one. Goods purchased on account for future use in the business, such as store supplies, are called A, accrued liabilities, B, expenses, C, revenues, or D, prepaid expenses. What do you think? Hurry. Okay. Okay. Goods purchased on account for future use in the business, such as store supplies, are called, you're absolutely right, prepaid expenses. So in this case, this would be called prepaid supplies. It could be called prepaid insurance. So there could be different names for it. Store supplies can also have the account title store supplies. It can also have the title supplies. Unless it has expense after it, in that case, it is a prepaid expense, which is an asset. So make sure you know when we're talking about supplies, when we're talking about supplies where it says prepaid supplies or store supplies or supplies, that is an asset. If it says supplies expense, that's an expense. So we'll get a lot of practice on figuring out the difference between the different accounts. Okay? Now, another one. All of the following accounts would be considered assets except for A, cash, B, retained earnings, C, prepaid expenses, or D, notes receivable. See, that stuff isn't hard. Okay, so the answer, you're right. The answer is B, retained earnings. Cash is an asset. Prepaid expenses are an asset. Notes receivable is an asset. So retained earnings is an equity account. Okay, so now what we're going to do is we're going to do short exercise 2-2. If you have it in front of you, you probably want to turn to it. Okay, so we have the company. I'm going to skip to the bottom. We need to A, figure out how much total assets that the company has, and B, how much in liabilities does the company own. So we go back to read it. Smith Software began with cash of $11,000. So they started with cash of $11,000. Smith then bought supplies for $2,400 on account, and separately, Smith paid $5,500 for a computer. Okay, so in answering this, what we need to do is we need to, okay, first of all, starting with cash, okay? Cash is an asset. And, you know, we're looking for assets and we're looking for liabilities. So cash is an asset. That's our beginning balance of $11,000. Okay, so if I were doing this off to the side, I would make a little running total of assets because we know we need that. So we'll have assets off to the side, 11,000. Then we want to have another account, list off to the side for liabilities, but we don't have one yet. So we start with the beginning balance of cash of 11,000. Okay, so then the next sentence, Smith then bought supplies for $2,400 on account. Let's dissect that statement there. Okay, so every transaction impacts two accounts. That first sentence didn't impact two accounts because it's simply saying, here's our beginning balance. The beginning balance is not a transaction. But Smith bought supplies for $2,400 on account. So we're going to dissect this. Every transaction has two sides. Okay, so I'm going to start with you. You get the easy one. What one thing is impacted by buying supplies on account, with one account? Yes, that's what I'm looking for. And what kind of account is supplies? It's got to be an asset, liability, or equity. What do you think?
It would probably be a liability.
Asset.
Okay.
It's an asset, yes. You're right, it's an asset. Okay. Supplies are what we're getting, okay? We're buying supplies. So what did we get? We bought these supplies. We're getting $2,400, and that's an asset. So are assets increasing or decreasing?
Assets.
Increase, yes, because we're getting these supplies. So assets are increasing, so we can add $2,400 to our assets. Now, the other side of that transaction, anyone know what the other side would be? Oh, right here.
$2 from the $11,000.
Yeah, that would be a good start. I'm going to revise it a little bit. Yes, he is reducing. Well, he will ultimately be paying cash, but he's not paying cash. And the reason we know he's not paying cash is there's two words called on account. Okay? On account. This is a huge, important thing. Whenever you see on account, that has a very specific meaning. So we're Smith Software. Okay, so we're Smith Software. So if we buy something on account, that is a liability. I buy the supplies, so I get the supplies, and I issue an IOU is what I'm doing. So I have a liability now. So I'm increasing the liability there to $2,400. So on account, in this case, because I'm buying, it's accounts payable. What happens if somebody bought something from me? If I sold something on account, that's accounts receivable. And we'll talk more about receivable and payable. Receivable is an asset. Somebody owes us money. Accounts payable, we owe somebody money. So, okay, so supplies is an asset, and it's increasing. Liability, accounts payable is a liability, and it's increasing. You know how we said the accounting equation has to be in balance after every transaction? So we look at that transaction. Every transaction has to balance that assets equal liabilities plus equity. So if we increase assets for the supplies, $2,400, we have in our accounting equation we have $2,400 in assets. Then we have to have we have to either reduce an asset or increase a liability or an equity account. So in this case, we're increasing a liability. So in that transaction, we're increasing an asset and we're increasing a liability. Okay? So in your running total right now, we should have $11,000 under assets and $2,400 added to that. And then liabilities, we should have $2,400 in our liability column for right now. Okay, so another statement. Separately, Smith paid $5,500 for a computer. Okay. Now, when it says paid, okay, that means that's a cash transaction. So what kind of account is cash? Asset, yes. And is that asset increasing or decreasing? Decreasing, because we're paying it out. Okay, so now every transaction has two sides. What other account would be impacted by this last thing, the paying $5,500 for a computer? Equipment, yes, equipment. And equipment is what type of account? Asset, yes. And is it increasing or decreasing? Increasing, okay. So what we have there in the $5,500, cash went down by $5,500, and that's an asset, and the assets went up by $5,500. I just called it computer. It could be equipment. It's something in that family. Okay, so what we've got now, so we have gone through all the information given to us. We had a beginning balance, and we had two transactions. So now what it's saying is how much in total assets does Smith have? Well, we know we had the beginning cash. I think 11,000. I drew over it. We have assets, supplies, $2,400 increase. We have $5,500 decrease in cash for the computer, and we have a $5,500 increase for the computer. So for total assets, what we're going to have is we're going to have $11,000 plus the $2,400 supplies plus the $5,500 computer minus the $5,500 cash for total assets of $13,400. We only had one transaction impacting liabilities, and that was the $2,400. So that's how you do that one. That's not a bad one at all. You just need to go through and come through. And I would say the most challenging part of that is recognizing, at first you think that pay $5,500 for a computer, you only think about one side of it. But every transaction has two sides, at least two sides, two impacts. Okay, so another question here. When services are performed on account, okay, so we are answering this from the standpoint of the company performing the services, okay? So this could be a doctor's office performing medical services. When services are performed on account, A, cash is increased. B, revenue will not be recorded until the cash is received from the customer. C, accounts receivables increase. D, accounts payables increase. And this one's kind of a tough one. It is meant to be a tough one, so think about that. I'm going to go quiet for a minute. Okay, on this one, so as we talk about it, first of all, when you see the word on account, okay, on account means you've got accounts payable or accounts receivable involved, okay? So at that point, when you see on account, chances are the answer is going to be C or D. So then you have to decide which one of these is it. Which thing is on account? Which way are we going? Now we're saying we're the company performing the service. So does someone owe us money or do we owe someone else money? If we owe someone else money, it's payable, accounts payable. So if we perform services on account, do we owe anyone money for that? No. So we can eliminate accounts payable, right? Because accounts payable is if we owe someone else money. Okay, when services are performed on account, that means we provided medical services. I'm just assuming a doctor here. So we perform medical services. The person owes us money, so that would be an accounts receivable. And when we perform those services, accounts receivable increases because now we have this asset. People are going to pay us in the future. So the answer is, okay. So accounts receivable is increased. So whenever you see on account, you have a good idea that the answer involves accounts receivable or accounts payable. So you have to think about, do you owe someone money, in which case it's a payable, or does someone owe you money, which is a receivable? Okay, a company received cash in exchange for issuing stock. So someone came to the company, gave the company cash, and the company gave out stock. Now remember, we are always analyzing these transactions, unless told otherwise, from the company standpoint. So this transaction increased assets. It increased assets because cash went up. Okay? So what's the other side of the transaction? What account? Would assets, liabilities, or equity be involved? I guess we have expenses, revenues, liabilities, and equity. What is the company giving up? Yes, common stock. Equity, yes, absolutely. The answer here is going to be increased equity. When a company issues stock, it's saying, okay, give me money, and in return, we'll give you the stock. And when we issue stock, when the company issues stock, it is an equities transaction. Okay, so when a business purchases land on account, ooh, on account, is that going to be accounts payable or accounts receivable? Accounts payable, excellent. So we already have determined that we have accounts payable. What type of account is accounts payable? Liability, yes. Okay, so we've already determined that. We haven't even looked at the answers. We purchased land on account. On account, it's accounts payable because it's a liability. So A, both assets, before we go on these, okay, so we purchased land on account. We said we increased liabilities. Now what's the other side? What are we getting in this transaction? Okay, we're saying we'll pay you. So I'm the business, and I buy land from you, and I say I owe you later. What are you giving me? The land. Yeah, the land. Okay, so land is what type of account? Asset. Yes, asset. Okay, so we know that we're getting land. Is that asset increasing or decreasing? Increasing. Okay, so now we just need to find the answer. So we increase land, which is an asset, and we increase accounts payable, which is a liability. So looking through our answers, both assets and liabilities are increased in that transaction. Okay, so we're increasing land, and we're paying for land by incurring a liability. Okay. Okay, so now, short exercise 2-3. Now, short exercise 2-3, it tells us that it gives us a list of transactions. So we have April 1st, 1st, 2nd, and 3rd. The convention, the first time we mention a month, we write it out, and then the rest of those numbers relate to that same month. So we have a bunch of transactions there, and it says, after these transactions, how much cash does the business have to work with? Use the T account to show your answer. Okay, well, a T account is nothing more than just a way to keep track of what's in an account. So we're going to just tackle this in the first transaction. Okay, so she invested $27,000 cash to start the medical practice. The business issued common stock to her. Now remember, every transaction we analyze is from the standpoint of the business. So in that transaction, is cash impacted? Let's start with this. Is cash impacted on that April 1st transaction? Yes. What happens to cash? Increase or decrease? Increase, exactly, because the business is increasing cash by $27,000. Okay, so second transaction, purchase medical supplies on account. Is cash impacted on that one? No. Okay, so April 1st, Brian, can you? Okay, so you said no, it was not impacted. Okay, so we don't need, for this particular problem, the April 1st purchasing medical supplies on account, that is a transaction. However, it does not have any impact on cash because we're getting supplies and in return we're giving an IOU. We have a liability there. So there is no cash impact for that second April 1st transaction. Okay, so we don't have any impact on cash. Okay, the third transaction is paid monthly office rent. Okay, paid monthly office rent of $3,500. Well, if we pay monthly office rent, cash is impacted. Okay, when it says paid, that's implying that we're paying cash. So we paid office rent. And cash will be reduced. So I put a minus sign in front of that 3,300. So I'm just kind of keeping a running. How about 35? I can't. Ooh, this is going to bug me. Okay, so make it, do it as I say, not as I write. Okay, so 3,500 minus 3,500. What? Well, I'm going to change slides, so fix it on the next one. Okay, so on April 3rd, can you change? There. Okay, so you can just fix that 3,300 now. Okay, April 3rd, we recorded 8,300 revenue for service rendered to patients. Okay, so what's happening here is we did services for 8,300. Okay, so we have those services. Then we received cash of 2,200 and sent bills to the patients for the remainder. The only cash impact in April 3rd then is the 2,200 cash that was received. So the cash increased by 2,200. So when we're answering the question, how much cash does the business have to work with, we've got the beginning balance, we've got the 27,000 we got on April 1st. We have the cash we spent on April 2nd of 3,500, and then we have the cash we received on April 3rd of 2,200. Okay, so when we so when we put it in a T account, first of all, and we'll get more into T accounts, but T accounts, cash. Cash is an asset. Debits increase assets, credits decrease. So cash, we put the 27,000 first. Then we have 3,500. If we put it on the right-hand side, it's a credit, and it represents a decrease. We don't use negatives in T accounts. Whichever side they're on tells us what's happening. So the cash is an asset, so the 27,000 increases cash, the 3,500 decreases cash, and the 2,200 increases. Now, how we get a balance of our cash account then is we draw that single underline under it, and typically we'll write the word balance. So we'll add up our debits, so we'll add the 27,000 plus the 2,200, and then we'll subtract the credit of 3,500. So we add up all the debits, subtract the credit, and the balance is 25,700. It belongs on whichever side is greater, and in this case we have more debits than credits, so it's 25,700. What that T account means right now is at the end of this month, she has 25,700 of cash in her account. So T account is just a quick way to keep track of what's going on in an account. Okay, so Brian's going to reload the next set of slides. Any questions? We're going to pause here for a second. Any questions about anything? No questions? Oh, yes.
Why is accounts receivable?
When services are performed on account, why is accounts receivable increased? Okay, accounts receivable is an asset, right? Will you give me that? Okay, so if I'm the business and I perform the services, so someone owes me, okay? So I perform services, then now they owe me. I wasn't owed that money before. Let's say I do $2,000 worth of work, and now they owe me. So they owe me $2,000, so my accounts receivable is going to increase by the amount that they owe me, the asset. Okay? Anyone else? Oh, you're ready. Okay. Great. Okay, so exercise S25. Now, this one I've kind of adapted. You have to give an example of a transaction that would be each of these. So what I've done for our purposes here, we're not going to we're not going to do polling on all of these. I'm just going to walk around and get answers. So we have these we're supposed to give an example of a transaction. So A is increase one asset and decrease another asset. B is decrease an asset, decrease owner's equity, that kind of thing. So what I'm going to do on this one instead is I'm going to put up, next slide. Okay, so I have the example here, paid dividends to owners. So what you need to do right now is determine which A, B, C, D, or E that is. And we're not doing polling on these, so you don't need to click in on this because they'll go by pretty quickly. So if you're taking notes, I would just jot down paid dividends to owners. That's going to be an example of one of those things. So when you do that, what I would do, don't even look at the answers, just say what's happening here. If we pay dividends, what are we giving out? What? Money, cash. Yes, yes. So we're giving out cash. What's happening to cash? What kind of account is cash? Asset. Okay, so right now we know that cash and asset decreased, right? So we can eliminate many of those answers. Okay, so we've decreased an asset. Now the other side of this, paying dividends. Paying dividends, I'll tell you on this one, paying dividends reduces equity, period. Okay, paying dividends is considered to be a return of equity to the owners. So in this case then, our answer, this is going to paying dividends, is an example of decreasing an asset, which is cash, and decreasing owner's equity, which is equity. So that asset equal liabilities plus equity, we've decreased cash and we've decreased equity, so we've impacted the accounting equation the same on both sides. Okay, our next example, purchased office supplies on account. Okay, so first thing I want to ask you, I'm ignoring the answers for right now, is on account. On account automatically means accounts payable or accounts receivable. Is that accounts payable or accounts receivable in this transaction? Payable, yes, it is accounts payable. Accounts payable is what type of account? Liability. Okay, so, and are we increasing or decreasing that liability? Yes, we are increasing the liability because we're going to Office Max, getting paper or something, and saying we owe you. So we've increased the liability here. So the other side of this transaction are the supplies we're getting. And supplies are assumed to be an asset because we're not using them the minute we get them. So we're buying 3 months worth of paper or something like that. So we're increasing assets and we're increasing liabilities. So this one, okay, increase an asset, which is supplies, increase a liability, which is accounts payable. Okay, issued stock for cash. What's one account involved here? Yes, cash. And what's happening to cash? Increasing. So we're increasing, she said, we're increasing an asset, cash. Okay. Now, do you know the other side involved here? Owner's equity. And is that increasing or decreasing? Increasing as well. Yes. So in this case, we are increasing an asset, cash, and we're increasing equity at the same time. So that's an example of D. Okay, our next example, purchased a building for cash. Okay. Hi. Okay, so let's start. Okay, so what's one account that's impacted here? Which asset? Which asset? The building. Okay, the building. So what's happening to the building asset? Increasing. Okay, so we're increasing an asset. Now what's the other side of this transaction? Cash. And what are we doing to it? We're getting the building, right? And then we're giving cash, so that would, no, decreasing an asset. You had the asset right. You're just decreasing, yes. So you're decreasing cash. So yes. So what we're doing there is we're increasing buildings and we are decreasing cash. Oops, I guess I just went too far on that one, but that's okay. Pay amount owed to OfficeMax for invoice from last month. So what's happening here, and this one is a little more challenging, when we pay amount owed to OfficeMax, we're paying cash. So cash is decreasing. That's where we're decreasing an asset. Now, when we pay OfficeMax, what we're doing is we're reducing our liability. We no longer owe them. So we're also reducing a liability. We're reducing accounts payable. So when we pay off something we owe, we're reducing cash, an asset, and we're reducing liability, that accounts payable that we would have owed. Okay, so another question. Which of the following transactions will increase one asset and decrease another? So we're looking for a transaction that impacts two assets, basically. A, the purchase of office supplies on account. B, the performance of services on account. C, the purchase of equipment for cash. Or D, the performance of services for cash. Okay, so how I would tackle this, if I were doing this problem, I heard the answer, so whoever sent it over there, good job. But if I were doing this, what I would do is I would go through each thing and say, is that impacting an asset? And the first time I found something that wasn't impacting an asset, I could rule that out. So A, for example, the purchase of office supplies on account. Well, office supplies is an asset, so far, good. But on account, if we're purchasing office supplies, is that accounts payable or accounts receivable? Payable, and that's a liability, right? So we can cross off A. Can't be A. Okay, now, the performance of services on account. Now, on account in this case, would that be accounts receivable or accounts payable? Receivable. So there's an asset. That's promising. But the other part of this is performance of service. When we perform service, we're increasing revenue. We're increasing equity. Okay, so it can't be B because performance of service is revenue. Okay, so now C, which incidentally is the answer, and I did hear it, so good answer. The purchase of equipment for cash. So we get equipment. We're increasing equipment, which is an asset, and we're decreasing cash, which is also an asset. So the answer here has to be C. And the performance of services for cash, again, performance of service is service revenue. Okay. Good. Okay, a company paid cash for an amount owed to a creditor. Okay, so the company's paying out cash. This transaction decreased cash, and then what's the other side of this transaction? Did it A, decrease revenue, B, decrease liability, C, decrease expenses, or D, increased expenses? B? Yes. Good. And then, can you backwards? Okay, yes. The answer is B, decreased liabilities. Would that be accounts payable or accounts receivable? Yes, it's accounts payable. So a creditor is accounts payable. If we're paying off a creditor, that's accounts payable. So we pay out the cash and we reduce the amount we owe the creditor. Oh, yeah. Okay. Good point. Okay, now 215A. 215A, basically it's saying, let's see, the following events were experienced, or so they were experienced by either the corporation or the stockholder. Okay, State whether each event increased, decreased, or had no effect on the total assets of the business. Identify any specific asset impacted. Okay, so we have to increase, decrease, or had no effect, and this is the impact on total assets. So A, we received $8,500 cash from customers on account. Okay, so we're receiving cash, which is increasing assets, and we're receiving it from customers on account. Is that accounts receivable or accounts payable? Receivable, which is an asset, right? So we're increasing cash, we're decreasing accounts receivable, so A is going to be no effect, okay? So the two assets involved there, even though there's no effect, are cash and accounts receivable. Okay, Flip, the shareholder, used personal funds to purchase a flat screen TV for his home. Increase, decrease, or no effect? No effect, because this is a personal transaction. Okay, has no impact on the business. Okay, sold land and received cash. Okay, so we've got land. What kind of account is land? Asset. And what kind of account is cash? Asset. So is this what effect? No effect, right, because we're increasing cash and decreasing land. Okay, borrowed $56,000 from the bank. Okay, what's one account impacted by that transaction? Assets. Okay, which account is that? Cash. Cash. Yeah. Okay. So we got $56,000 from the bank. What's the other side of that transaction? We borrowed $56,000 from the bank. That's typically going to be a note payable. Okay, but accounts payable, you're in the right vicinity. So that would be increased assets, because we're looking at the total impact on assets. So the asset here impacted is cash. The other side of it is a liability. So assets increased, total assets increased from D. Okay, made a cash purchase of land for a building site. So what happens to cash? Decreases. What happens to land? Increases, so no effect. Yes. Okay, F, received $22,000 cash and issued stock to a stockholder. So, did that increase, decrease, or have no effect on total assets? Increase. Yes, it increased because we got cash, that's an asset. Issued stock is an equity account, so that doesn't have an impact on cash. Okay, G, paid cash on accounts payable. So cash is an asset. Did we increase or decrease it? Decreased it. What's accounts payable? What kind of asset? What kind of account? Liability. Okay. So in this case, this would have decreased cash. Okay, would have decreased total assets. Okay, so in H, we purchased equipment. So equipment's an asset, so is equipment increasing or decreasing? Increasing. Now the second part of that, we signed a promissory note in payment. Is that note receivable or note payable? Note payable, and it's a liability, right? So H is going to be increased assets. Okay, I, purchased inventory on account. Okay, so inventory is what kind of account? Asset, and it increased, right? Now on account, is that accounts payable or accounts receivable? Payable, what kind of account is payable? Liability. So this will have to have increased. Oh, I did two of them. Okay, well I just did the last one as a bonus one. Okay. Go ahead. Okay. The business paid Flip a cash dividend of $7,000. Now keep in mind we're doing this from the business standpoint. We paid a cash dividend. That means cash went out, so cash decreased. Dividends impact equity. So the impact on total assets of J is it decreased. What? The business plays? Okay. We're not done yet. We've got another 6 minutes. Okay, so if a company declares and pays a dividend to its stockholders, both cash and expenses will decrease. True or false? And we can click in on this one. Where are we at here? Okay, so what do you think? True or false? False? Okay. False? False? It's not a false. What do you think? Okay, this is meant to be a challenging one. Let's talk about this. So I think I know where we're, okay, so if we declare and pay a dividend to shareholders, does cash decrease? Yes, okay, so we know, so that's not our stumbling block. Our other part of this is, will expenses decrease? Are dividends ever an expense? No, they are return of equity. So dividends have absolutely zero connection to expenses. So this one, everyone who said false, that is absolutely correct. Okay? Dividends are never an expense. They are reduction of equity. They're a return of capital to owners. But dividends are never an expense. So this one is false. Okay, and then I do really actually think that this is a good stopping point. So we're going to stop here, and we will pick up here and finish up Chapter 2 on Wednesday.